In one voice, please. Hi. Better. So we have awards also in the evening. I want you to save your energy and talk amongst yourself less so that you can save that energy and enjoy with us till the evening. Late night maybe? Let's start this panel first. So this panel is all about key challenges in balancing the power of sustainability and profitability. As we all know, I've been talking about it since yesterday, that a lot of brands started their journey during the COVID pandemic. And at that point of time when they started out of that need. And we have seen that they want to learn how to earn profits and sustain their business for the longer terms. So this is what we are going to discuss today. The topics will be delving deeper into are sustainability and profitability, understanding the importance of both, attention to sustainability to increase profitability, building a robust and sustainable supply chain to earn long-term profits, making sure that every detail counts. Whatever decisions we take should be taken keeping in mind the long-term sustainability of the brand, and how can brands invest in a better future. So we'll start first with Manas. Which side is Manas? Oh yeah. So Manas, my first question is to you. Brands these days are focusing on disrupting the categories without realizing that they end up making losses, right? So, you are also disrupting the category. I just realized. So what can brands do to build a sustainable and profitable business?
Yeah, so I think you have put it in the right sequence. Historically it has been proven in India that any big business, it became big by either disrupting or creating a category. So, but I don't think it is practically feasible, at least to an extent in my category, that on the day one itself you can be profitable, sustainable, and at the same time you can disrupt a category or you can create a category. But if you are about to, if your business, long-term business goal is to disrupt or build a category, then of course if your fundamentals are strong, what do I mean by fundamentals is, if you have the right product market fit, and then you have a great gross margin, and you have a great, working capital cycle is very robust, then in that case, I think even if you are, compromising a little bit on the initial days for growth, you will be able to achieve your profitability or sustainability after a point of time. Look at the case of Jio as a matter of fact, right? They were very clear on what they wanted to do, and in fact, they just not disrupted one category, they just disrupted the whole industry, right? But they were not profitable on the first go, but eventually they became profitable, right? So if you have an eye on a long-term, plan on what exactly you want to achieve, if the fundamentals are strong, then I don't think it is a big deal for achieving a profitability and sustainability together, at the same time achieving it at a scale or a growth.
Right, the fundamentals of any brands need to be really strong to make sure that they sustain and earn profits in the longer term. Ganesh, I would come to you and I'll ask I answered myself, but I want Ganesh to delve deeper into it. So why is there a need to build sustainable businesses, and what are the key ingredients involved to build a sustainable business?
So, my perspective on sustainability is primarily to build positive cash flows first, right? Profitability comes as the next step. And it's a very simple equation when you look at cash flows. You need to get cash faster than it's going out, right? That's as simple as that. Just, simple things that you can take care of right from the early days is understand what your revenue cycles are from every channel, right? So for example, D2C, if you're selling on your own website, you can get it within 1 or 2 days. If it is COD, you will get it within 5 to 10 days. If it is on a marketplace, you will be at a 15-day to 30-day cycle. If you're offline, the cycles might be longer. Then you balance it out with what your supplier agreements are, right? So if you're able to get supplier credit for a longer term so that your inventory is sold and you start getting revenues faster, that is something that you can do. In our case, for example, we are a footwear brand, Flatheads. it takes 110 days for us to make a shoe, right? And supplier credit initially is hard to get. So we were at 60 to 90 days supplier credit we had negotiated. But then we had to short circuit the revenue cycle to get money in to start paying the suppliers. So what we started doing was running pre-order campaigns as well, right? So 1 month before we actually sold the product, we had already done a pre-launch and started collecting money from customers. So you need to adopt your business model to get those cash flows in, right? Of course, then there are enablers. If your margins are sufficient to cover interest costs, you can also fund your inventory through working capital loans and stuff like that. But inventory turns is one thing that you need to keep a very, very tight eye on. These are fundamentals of finance, but it's hard to do when you're an early stage founder and also fighting product and growth trajectories itself. But yeah, those are fundamentals that you just need to keep in mind, is what I think.
So for some, it's simple mathematics. For me, it's a nightmare. How many of you have been able to solve profitability issues for yourself? Please raise your hands. I'm very bad at maintaining my own finances. Is everyone else like me? Oh, I'm not feeling, I'm the only one then. Thank you so much for supporting me. So next we come to you, Aditya. I want to understand from you profitability and sustainability in a funded VC ecosystem versus non-funded traditional ecosystem. How are they different?
After getting acquired by ITC, we have now much more visibility into how things they do. And that's given a lot of fresh perspective. Large companies don't have the option to fail. But on the other hand, if you look at VC-funded companies, inherently they are okay with 7 out of the 10 portfolio companies failing. And that completely changes the dynamics on how you are trying to build. Let's take a specific example, right? There are certain, we have been blessed with very good investors, but there have been cases where, you cannot put rocket fuel to a car and expect it to fly. And understanding if that is relevant to your business, especially because in the VC-funded ecosystem, right, there are a lot of folks who come from a tech sort of a background, and that might not necessarily be applicable to all sorts of businesses, especially the kind that's here. I think that's one big difference. The other is the emphasis on top line versus bottom line. When you are raising funds from a VC, you are looking at a 5-year cycle, 7-year cycle, because they're all looking at exiting, and your own next fundraise is a few years down the line always. So you're only really chasing top line growth. Of course, you're fixing your bottom line, but that's very, very differently looked at the larger companies. So what you look at from a metric perspective inherently with respect to your bottom line and top line is very, very different, right? And that impacts a lot of decisions with respect to short-term versus long-term. And I think that's primarily the main difference, right? Because of the way the exit cycles work.
So it is a very tough environment these days. I must say the business are grappling, they are understanding because they are new age D2C brands. And I'm sure I am also learning from them. So Satish, coming to you because I uprooted you from here. So I'll ask you first then. Can you tell us that sustainability and profitability, can they go hand in hand? And if yes, how?
I would tweak the question a little and then come to the original.
I'm the moderator.
That's fine. I would say, I would rather ask, should it go hand in hand? And I think the answer is clearly yes, it should. Can profitability and sustainability go hand in hand? Very well. I think I'm just going to take a step back and take a cue from what Ganesh said. So sustainability, if had to be sort of put in a mathematical equation, would become profitability into time. If you're able to stay profitable over a period of time and have the power of time compound, that profitability is where you end up becoming sustainable. Profitability is analogous to how you read a profit and loss. It's largely expense and revenues and expenses, while sustainability is a derivative of what a balance sheet looks like, which is assets and liabilities, right? Things can go wrong in a lot of setups. For example, if you're profitable but with very paltry profits and irregular profits, the power of compounding will never kick in. Second scenario could be, you could be a fast-growing startup, if profitable, but largely works with a very high amount of leverage, be it a cost of debt being ridiculously high, or in some cases, extremely built on equity capital. And that is where you might be in a situation wherein your liabilities might always overweigh the assets. Or the third case could be, and these are all pertinent to D2C, by the way, any D2C company which is very capex heavy might largely end up seeing its working capital getting choked into capital assets, fixed assets, and something which would always necessitate the business to keep raising more and more capital. I think if these things, three things scenarios, and there could be multiple, numerous scenarios, if these aspects could be taken care of, then it is pretty much easy to be sustainable over a long period of time. But I think time is the common denominator here. One needs to be patient. One needs to continue to focus on profitability. Something which has worked for me, which I would like to share. I believe, and that's my thesis, that it takes a minimum of 5 years for largely bootstrapped or conservative businesses to get to an inflection point, to be able to derive a critical mass for themselves. And unless something really wild and wicked happens to the company or the founder doesn't lose their mind, such businesses become sort of unstoppable because they are sustainable.
So, but one thing, from my personal side, I want to know, D2C brands owners को नींद कैसे आती है जब losses हो रहे होते हैं? मुझे तो नहीं आ सकती.
I can't comment on that. We've been profitable from day one. So. But I can address it in a different way. See, working capital becomes the biggest challenge for bootstrap businesses, right? So I think it's important to take a decision on timing as to when do you want to do what you want to do. For example, sometimes because of a lot of pressure, you might want to scale up. And the natural thing to come would be to get into the adjacent categories, or to be able to scale up to a different market, or to be able to drop your prices. Every decision you take has an impact on P&L and balance sheet. It is very important for the founder or the founding team to be able to step back, hold their breath, hold their thoughts, and take the right decision at the very right time. So I think timing is essence, and if you're able to time it well, not sort of, to be able to put your head down, focus on what you're building. Sustainability might look like a distant affair, but with profitability along your side and time, something which you would create for yourself, sustainability is easy to come by.
So if profitability comes, sustainability comes on its own. This is what?
Yes, for sure, yes.
Pleasure to know. So Juhi, apart from being a content creator, you are a wonderful entrepreneur as well.
Yes.
So I want to know from you, what common mistakes do brands make while being on the path to build a sustainable business?
It's actually very interesting. The topic of this panel is a very common point of discussion at our office on a day-to-day basis. My husband, who's also the co-founder at Arabellaa, comes from a very traditional setup. He's also part of his family business. So they're quite conservative when it comes to taking risks. And his approach towards business is very sustainability focused. Whereas my background is marketing, and I'm a content creator, so I'm like eating, breathing, and sleeping marketing. So I'm all about trying to innovate and coming up with new ways to kind of do something groundbreaking. So I feel like in our office, it's kind of great that we're kind of striking the right balance between sustainability and trying to do something to, work towards profitability. So coming to your question, I think the biggest mistake is the fact that brands don't focus on striking a balance. Sometimes brands are too focused on just one aspect, and, that's not how I feel you can kind of approach it correctly. And also, it's very important to get your basics right when you're running a business, specifically when you're starting out, It's very important to, for example, have the right relationship with your customers, build their trust, to be proud of the product that you're putting out there, the quality, to just kind of build this ecosystem that's very well balanced. And after that, I feel sustainability and profitability will follow. But the most important thing is to, always try to strike a balance.
I second your point. Anand, coming to you, can building sustainable supply chains help brands maintain profitability? A different angle to what I'm trying to understand.
Could you just repeat that for me, please?
Yeah, sure. Okay. So, can building sustainable supply chains help brands maintain sustainability?
So I think once you create a store, right, and once you create like your product, the only second thing that you need to manage is your supply chain, right? It's very important to be at the right place at the right time. But I think we fairly confuse supply chain with warehousing, right? We feel that we have a good warehouse and material is coming in and going out is good supply chain management. Supply chain is way deeper, right? It's your raw material source, it's your manufacturing, it's your warehousing, it's your distribution, and then it's your last mile delivery to the consumer. So just imagine, and I'll take an example of the industry that I come from. There are a lot of variables. A shirt that you wear, I think the raw materials are coming in from 10 different places for a shirt, right? The fabric is coming from a separate source. The buttons are coming from a separate source. Thread is coming from a separate source. Now, once you start scaling up your store and the other partners are not aligned, say your raw material partner is not aligned to how you want to scale up, or the moment you start a store, your product sees some fantastic response and you need to refill them quickly, but everybody else in the value chain is not aligned, there is a loss of sale and loss of opportunity there. So if there is a loss of sale and loss of opportunity, you will never be sustainable. You will never be profitable, right? You have to make sure that right from your raw material supplier to your manufacturer to your warehousing partner, or if you're managing your warehousing yourself, all of the people in the supply chain are aligned to the common goal, right? They're all agile. They're all agile businesses. To just give you a quick context of our own brand, pre-COVID, we were selling about 1,000 units a day. So that's roughly 30,000 units a month. And then COVID hit, and there was a rush to online shopping. Because of the robust supply chain that we could develop, we transformed the 30,000 pieces to selling about 5 lakh units in a year and a half, right? So
that's wonderful.
Yeah. So I think once your store is there, your product is there, the only next thing that can make you profitable is your supply chain management. And again, say there's a festive coming up and you need a line of kurtas, right? Just imagine launching kurtas in peak winter. It's not going to click. It's actually going to be non-profitable. There is going to be carrying risk of inventory, a financial implication on that inventory as well. So therefore, supply chain is a very big term. I think it's a complete subject in itself, but that subject is so important for sustainability and profitability that I think the founders need to all focus very, very hard on building the right supply chain mechanism.
I second your point too, because I'm learning, so I'm actually agreeing with whatever the panelists are saying, because they are much more experienced than me in running businesses. So Vinayak, you bring a different perspective to the panel, because you are actually helping D2C brands build a name for themselves, right? So I want to know from you, how have you seen D2C brands make a move towards sustainability and profitability recently?
Right, so I hope I'm audible. Yeah. So I don't run a brand myself. We actually work with a lot of D2C brands as a tech enabler. So I think when D2C started, right, like when it started picking up in India also, let's say 5-7 years back, Facebook ads were quite cheap, and D2C was largely a top of funnel play where everybody would get like fair, sustainable returns on ad spend. Wouldn't really have to optimize your website, your conversion rates, your funnels, your retention flows as much. But I think, and we've seen this in like more mature markets, like let's say the US also, over time, as competition increases and more and more brands come up, the cost of ads has really gone up, right? Every D2C marketer would sort of resonate with that. And we've seen D2C then sort of move from a very top of funnel focus to more of a middle of funnel and bottom of funnel focus. And what I mean by that is that a D2C marketer's primary focus would then shift from a very performance marketing strategy to also an owned marketing strategy, where you can figure out, okay, these are my channels. Let's say pick up a channel like email or WhatsApp or SMS. These are channels where I own my customer data. And basis what people have done on my website, I can now reach out to these customers and generate revenue on my own. So there's going to be this shift from performance marketing. That'll still, of course, be there. Like you'll have to drive new customer traffic, but owned marketing is something we see becoming more and more of a focus, which was largely like consumer tech would essentially focus a lot on retention and things like that. And we see that happening more and more in, let's say, D2C. Coming to the maths of it, I think like D2C is a 2% conversion rate business. A lot of people come to the website, you spend a lot of money. 2% of those website visitors actually end up converting. And if you think about it, if that 2% just goes to 3%, your ROAS actually goes up by like 50%. That just like changes the unit economics of your business very fundamentally. And we've had some interesting learnings there. Like the vantage point we have is brands across the board trying different stuff. So we've seen the primary differentiator in strategy here being the average order value. So for brands which are relatively lower average order value, right? We've seen those categories be tougher. Like some have even made the move to like marketplaces and like quick commerce platforms. So that has definitely been tougher. And the ones that have continued to like have D2C as a very core channel, they really go deep on repeat purchases. Like you'll see 30-40% revenue coming in from repeats. And that's been like the only area of focus there. And we've seen brands getting very creative there. There's this peanut butter brand that works with us. They do like a good 20-30,000 orders a month. And for them, again, this was the same challenge. Average order value would be like 500-600 rupees. Very hard to actually get profitable on that. And they actually stopped like Facebook ads, the conventional Facebook ads. They started doing ads on Paytm. They started doing ads on Google Pay and a lot of other things. They started doing these ads on Instagram and Facebook, which click directly to WhatsApp as a channel. And that really picked up well for them. Like they had like this telesales team, they had like a larger support team. So people would click on these ads. They would then talk to these customers, call them up and convert them. Whether it's like a product concern, whether it's some additional discount that they needed, that worked great for them. We saw this brand that does, that sells honey. They made this interesting feedback and cross-sell flow because they figured that, okay, honey is something which if I try it once and I like the flavor, I'd probably like buy it again. So they'd send out this message just to collect feedback on a channel like WhatsApp, and people would share their feedback. And if the feedback is good, then they would go ahead and cross-sell. They would not do it for everyone. If the feedback wasn't great, they would like redirect it to the support team. So with like these food type of categories are generally lower average order value. This is something we've seen. For higher average order value, we've seen it ends up being a game of trust because the ticket size is high and the purchase frequency is also going to be lower. So, so for let's say a category like let's say luggage, right? Like we work with Mokobara, for example. So Mokobara, they have like a high enough average order value. You go to their website, you browse different products, and you'll see ads following you around on Facebook and Instagram. What they also started doing was that they had this pop-up on the website. It would take like a phone number or email and that kind of stuff. And then they would retarget people who are not just abandoning carts, but also just browsing the product and leaving. And then they would reach out and be like, okay, hey, what went wrong? Could we help you with like some product question or give you a discount? And then there would be a very active sort of support there to lead to a more assisted buying kind of an experience, like similar to what we see in some high-ticket retail stores, right? So that was like the bet there. But yeah, I think the challenge is of course like harder and a lot more nuanced. But this is just like some interesting stuff we've seen.
Vinayak, a small question in my mind. When you say to talk about that brands, investing for marketing on social media platforms, maybe it's also Google or something like that. So when they invest, and after some time, what if the algorithm changes? I mean, one day unit economics go for a toss.
No, I think exactly the challenge which all D2C brands sort of struggle with. It's not like a choice, because like a lot of D2C products are sort of introducing something new into the market, right? So you'll have to be there on Facebook. There's this brand that Nova, they sell like the bottom of ice cream cones. Now that's not something I'm going to search for. So you'll have to show me an ad on Facebook or Instagram. That's when I sort of check it out. But once that discovery has happened, then you try to own as much of the customer relationship as you can, which is why like this entire shift around D2C happened, which is why like marketplaces only wasn't an ideal strategy long term. So that risk exists, which is why you then sort of try to get initial attention there and then own the customer relationships using your own channels.
Okay, thank you. Satish, coming to you, which are the other areas where brands can integrate sustainability with profitability?
Yeah, I think the areas are going to be pretty much straightforward in an operational context. Again, bifurcating it into profit and loss and balance sheet. From a profit and loss point of view, the first and the foremost thing is to be able to be profitable, which means you need to focus on a double-digit profitable growth. For that, I think key thing is to start with better gross margins and always have a threshold for your gross margins. You know, we often get caught in a very cyclic loop of wanting to discount our products time and again. As I keep saying, every day in our country or on e-commerce is a deal day. So I think, you know, there has to be a threshold of your pricing below which one should not go, because otherwise you start from your gross margin, which is quite compromised, which will eventually have an impact on your EBITDA. That's number one. The second aspect should be, you should continue to look at a double-digit EBITDA as you scale up, because as you scale up, with inflation continue to increase year-on-year, raw material cost, your cost of goods would increase. Like I said, with deep discounting, the selling price would continue to go down, and marketing has just been a bane for almost all the D2C brands, barring a very select few who consciously choose to not scale at a lightning pace. So if you do all that math, you would suddenly, let's say, start at a 15% and then go to a 2%. Now you are profitable, but there's no joy in having a single-digit profitability, especially when you are looking at a multi-fold or a 100% or a 200% year-on-year growth for the next few years. I think the third and the fourth points are largely balance sheet driven. The third point is which I think Ganesh already spoke about. You have to understand your purchase and a sales cycle and to be able to align it. For example, you cannot be carrying your inventory for 6 months if you know that your sell-through is 90% in 1 year, which means you have to just way too much inventory. So one part of it is to be able to sell your inventory on time, and I think there's technically no benchmark. It would differ from category to category, but a sweet benchmark would be to have a sell-through of 75 to 80% in a span of 3 months, and that's largely what the production cycle for a lot of categories would look like, which means never be overstocked than what you can sell. So it's as simple as don't take more than what you can chew, because that's going to stress your balance sheet, which will come back to haunt you. And that's when we start talking about liquidating our inventory, which possibly could command the right margin, but just because of being impatient and having taken a wrong decision is where we end up falling prey to some wrong decisions. I think the fourth bit would be something which a lot of people, including us, we have not really been able to crack, which is the accounts receivable in a very finance parlance. Largely, I'm relating or referring to payments reconciliation. For a lot of D2C brands, a classical case is not all the returns come back to you. So returns which do not get delivered to you are technically your sale and profits on book, but those are big leakages. Leakages which, unfortunately, as you scale, it becomes monstrous to get into the detail, or rather, I would say at a row-level reconciliation. And what we have seen is that the more and more you get into it, you're able to sort of save a 2 to 3% in your EBITDA, and that could mean a lot to different scale of businesses. So I think that's something which one should really look at. And I think the fifth bit, which is more of I would say something which I follow and share with my fellow founder friends, is that never look at a P&L in isolation. A P&L should never be looked in standalone. It has to be read alongside a balance sheet. So yeah.
So, Tish, you've learned a lot from your experiences, and you have actually elaborated this answer in a very nice way, and it's a very informative piece that you have shared with us.
Thank you.
Yeah. Aditya, coming to you, we have seen that lots of D2C players are either being acquired or the mergers and acquisitions are on the cards for a lot of them recently. So, impact of profitability and sustainability during mergers and acquisitions, I want to understand from your side.
Okay. So there are two ways of looking at this. You can get acquired by another company which is also very well funded, right? You could get acquired by something like a roll-up brand. You can get acquired by something like a roll-up brand. You can get acquired by someone else who is very well funded, is not seeing the same kind of growth or wants to go public. These are usually VC backed. And on the other side, you have the traditional companies. Now with the funded companies, the conversations with us had traditionally been along the lines of increasing top line. I think the market's changed a lot over the last 1 year. And I think now there are far more questions on what bottom lines start looking like. But the conversation that we had with respect to the traditional companies, there are about 10, 12 of them which were about the right size that could acquire us, right? And each one of them absolutely talked about profitability. It's the first thing that they talked about. On the other side, the funded companies talk about bottom line, they talk about growth much more. With respect to the traditional companies, it was not just about profitability, it was a lot about the sustainability also, which means the quality of sales. The quality of sales is super, super important. If you get your sales just say from a DTC ad campaign and you run it and you inflate your growth and then you say, this is my ARR, that doesn't work really, right? Like it works for an investor pitch deck. It doesn't work the same with traditional companies. What is your net revenue? ARR is not a thing. As Satish said, there is far more, what you collect is what your revenue is. There are different ways of saying that you're profitable. There are different ways of saying that you're growing. There are different ways of saying, ye mera GMV hai, all of that. But net revenue, actual bottom line, gross margin, something that we learned in the process. There are small changes to your top line and small changes to your bottom line can impact your gross margins a lot. Deep down, as founders, as entrepreneurs, we all know this, कि यार ये change हो जाएगा, but investors don't question it the same way. But when you go out there to sell the business, when you're looking for an exit, these questions become far, far more pertinent with respect to how you want to, what kind of valuation that you get. Secondly, at the same time, unlike investor pitches, one thing that is very, very different here is, there you can say, I will grow 7x, I will change my EBITDA margin from 5% to 15%. Here, whatever you say, you'll be held accountable for it in some way or the other. Your exits would most likely be also at least be a part of what your profits are. So whatever growth plans that you're projecting them also have to include certain profitability numbers. If you don't have profitability numbers, anyway the exit is difficult. But if you do have those are things and those are numbers that you would be held accountable for in your final exit. Often that is the construct that I've seen so far, right?
Thank you for sharing this. I will not add my comments because the time is up and I have 4 more panelists to speak about the topics still. We'll quickly try to wrap it up. I'll come to you, Anand. Can you tell me one thing? Can adopting tech in a big way help brands build sustainable and profitable businesses?
So I think there is no other way other than tech. I think tech is the only solve. If you're not using tech, I don't see how you can be sustainable and profitable, right? In today's world, at least, right from your WMS to your OMS to your ERP to your order management or your buying to what the consumer wants and how the consumer wants it to be delivered to him, all of it is a tech solve. We are living in a tech world. I think tech is not only for ETRetail or e-commerce or D2C. I think tech is a solve for a lot of, online, offline, and our lives. So I think from business perspective or from where I come, from a fashion background, I can surely tell you that I think we've been fairly successful because we've been able to implement a lot of tech at every level, right from, understanding the consumer demand to forecasting sales, right? When you talk about D2C, understanding what the consumer is coming to your store for, right? And why is he going away if he's not buying? If you're able to, and beyond a certain scale, it becomes impossible for any of us to do it manually or, without any system intervention. So I think both my questions, I think answer roughly the profitability very, very well. I think supply chain and tech, both are very, very essential. Since we are short on time, I would just leave it for the other panelists to maybe add something.
Thank you. Ganesh, can you quickly tell me, can better investments result in building a sustainable brand?
I think just carrying on from what Anand said, if I had to make an investment in building a sustainable and profitable business, number one, marketing stack, right? Understanding what your return on investment is on marketing, and balancing that out with a longer term, branding effort, which actually builds the brand identity over time, rather than just relying on Facebook and Google ads. That is number one. Number two, sales intelligence, right? As you rightly pointed out, just understanding which ones of your SKUs are selling, accordingly building the right inventory to make sure your turns are quick, right, is very critical. So you have to be on top of what is it selling, what isn't selling, close down that, double down on the stuff that is selling. That has to be a very active process. So I would invest on that. Third, I would definitely invest on, at least in the scale-up stage, I would invest on somebody who is a finance person who understands these, allocations of, where revenues are coming from, how to allocate budgets, and, as Satish said, right, marrying the balance sheet, P&L and cash flow, right? Those aspects, you really need somebody who has a good grasp on business aspects of things from a finance perspective. So that's what I would invest on.
Thank you. Juhi, how are you weaving sustainability and profitability into your business?
Sorry, could you come again?
Yeah. How are you weaving profitability and sustainability into your business?
Okay. I think, as I previously said, for us, firstly, it's about striking the right balance. And again, kind of finding constantly what our challenges are and tackling that. I would actually like to mention a challenge, in fact, as a fashion brand that we often face. Our consumers are people who are constantly, on social media. They're kind of exposed to what's happening on social media very often. They kind of are also aware of what our competitor brands are, putting out there. So while we are a creative, business at the end of the day as a fashion company, we need to constantly kind of renovate a product, be creative with the product, and still, supply the best possible quality, because I'm very particular about, making sure that we're building our own textile, our own prints, and all of this is the time-consuming process. But at the same time, we also know that our consumers kind of want newness constantly because of social media. So to kind of keep up with that is a challenge. So yeah, I think just constantly figuring what your challenges are. And another factor I want to talk about is our supply chain. It's very important to, give enough importance to your supply chain. A lot of times I feel brands kind of ignore their supply chain after a certain point, especially the established brands. I feel like at no given time you can kind of ignore your supply chain. You should always kind of keep going back and always trying to get like better costs in an ethical way. I'm not saying that, you should, if you find a better vendor, you should move on to the next one. But in a very ethical way, try to constantly keep going back to your supply chain, making sure that it's in order and sort of create a well-balanced ecosystem. And yeah, just constantly finding what your challenges are and tackling them.
So when Juhi talks about challenges, Manas, I want to know about the challenges that brands face while building a sustainable business and a profitable business.
Oh, that's a very generic way to put it, because it'll be difficult to, depending on business to business and categories, right? So for example, if it is a food and beverage business, then if your focus is only to build a sustainable business, then you are compromising a lot on speed and pace. And today's time, it is everybody has easy access to capital. And if you're compromising on speed and pace, then someone else with a better access to capital can come and make you irrelevant, right? So so I would say that have a long-term vision towards sustainability and profitability is very important. But at the same time, ensure that you stay relevant to in the market, and you stay as if you wanted to conquer that particular category, then don't lose the market share also at the same time. That's where, again, going back to the same point that I mentioned, right? So if your fundamentals are strong, you don't have to worry about profitability and sustainability. You just keep building, keep focusing on that, on your business, and keep going towards your goal. The rest will follow up. Only thing is that you shouldn't lose the control. Just when you're growing very fast, and after a point of time you lose complete control on the whole thing, and then it will be very difficult to come back into profitable. That will be difficult. But otherwise, if your fundamentals are strong, then I don't think that would be a problem at all.
Thank you. Vinayak, last question to you. If you can sum it up the entire discussion and tell, how do you think D2C brands can move towards creating more sustainable businesses?
I think a lot of what these guys have said would be more applicable. But at our end, at least, a lot of the focus is on the tech, on the marketing automation side, on making sure we understand, we have all the data in the same place, use it well to have like the right communication at the right times. So that's at least our area of expertise. But I think a lot of what these guys have said sort of sums it up well, yeah.
I'm not concluding it. You have learned all the points about technology, supply chain, how to maintain unit economics, and be clear about what you are building and what you are serving to your consumers. Thank you so much, all the panelists, for a wonderful discussion. I really enjoyed it. I learned a lot from it. Thank you so much.